If you're like most people, you've probably heard the advice that paying off your mortgage is a must. The idea is to stash away extra money in your bank, asking for a mortgage reduction, with the ultimate goal of having your house completely paid off. And it's all fair to want it, because in 2023, people in the United States collectively owed more than $16 trillion in debt. The majority of it obviously related to mortgages. These debt figures have shot up even further this year, and we're only 3 months into the year. Your mortgage is probably the biggest debt you'll ever have. It's a hefty sum, potentially reaching hundreds of thousands of dollars or even millions of dollars, and you'll be chipping away at it for nearly 3 decades. Therefore, it might seem obvious to pay off your mortgage early if you have the opportunity to do so in full or in part, but that may not be a good idea. Before you make any quick move, you should note that many other major money decisions, there are consequences, and paying off your mortgage ahead of your schedule might actually do more harm than good. Now, I know that there are lots of psychological benefits of avoiding debt, but the financial ones, I'm not sure. In our new world, is that really the most crucial goal, to pay off your mortgage? Or should you be pushing so hard to pay off your mortgage? That's the question that we're going to be exploring today. And by the end of the video, I will tell you why owning a house that you live in may not be a good investment at all. All right, let's start with the valid reason why paying your mortgage early is risky. You might quickly think of paying your mortgage when you come into some unexpected cash, like winning the lottery or inheriting a surprise sum. But realistically, most people gather funds for mortgage payoff through regular savings. So it might not be wise to wipe out all of your savings to settle your mortgage. Why? Because emptying your savings can spell trouble down the road. You'll also not have any emergency fund, which isn't great, though the home equity can be used as financial backup, but that's not going to be a good idea. I'm going to come into that later. However, many people go into a step further to dip into their retirement savings, IRA and 401k that I'm talking about, to clear their mortgages. This move is generally a very bad idea. Using your retirement funds to pay off your house early might seem tempting, but it's a short-sighted decision that could bring financial challenges later on in your life. Striving for a debt-free life is admirable, but here's another crucial tip. If you're juggling various debt, it might not be the best move to concentrate on your mortgage just yet. Whether it's credit cards, personal loans, or car loans carrying a balance, there are a couple of solid reasons to tackle these first. Firstly, the interest rate on these debts are likely much higher than your mortgage. While the average auto loan hovers between 5% to 10%, credit cards can slap you with an APR between 15% to 25%. Personal loans vary, but regardless, it's not wise to sideline these debts for the sake of paying off your mortgages first. Secondly, your home is a reliable appreciating asset, meaning its value will tend to increase over time, making those mortgage interest payments more manageable. In contrast, your car loses its value the moment you drive it out of the lot. Don't think what I'm talking about? I cover my car buying experience on this video here. And credit cards or personal loans lack an asset that retains or grows in value. If your goal is debt freedom, it makes sense to focus on tackling these high interest balances without the appreciating assets first. Also, your mortgage agreement might not be too keen on early payment. The mortgage provider anticipates a steady stream of payment over the agreed upon term, complete with annual interest charges. If you decide to clear your mortgage balance ahead of its schedule, say after 10 or 15 years, the bank stands to lose out on the years of expected revenue. It's crucial to investigate any penalties associated with early payment on your mortgage. These penalties can be significant and may vary over time. For instance, settling your mortgage after 5 years might incur a higher penalty compared to paying it off after 20 years. In such cases, it might make financial sense to wait until the penalties decrease or vanish. And talking about making financial sense, hi, my name is Tasvir. Mirza. I'm a realtor and a diversified investor, and you are here for your dose of entertainment. Now, settling up a mortgage early might also have a downside impact on your credit score. The impact would be a brief one. However, it's essential to be aware that completely paying off your mortgage could potentially result in a negative influence on your credit score, influencing future borrowing costs. But paying off your debt is a good thing, right? Your credit score is a complex calculation involving various factors. One key element is the amount of outstanding debt and the consistency of your payment. Another factor is the diversity of approved debt type. Check this out yourself. If you have a mobile banking, or if you have a credit card that offers you free FICO score rather, you can go ahead and log in and check the report yourself. There will be a section where it says the type of credit and the length of credit. The credit score calculation involves the type of credit that you possess, such as car notes, mortgage, credit cards, personal loans, etc. Car notes or mortgage is a fixed monthly payment that you make every month which affects your score differently, and the bank sees that how responsible you are with your finances. Strangely enough, when your mortgage payments are no longer a part of your credit report, the credit score algorithm may perceive them negatively. It may seem counterintuitive, but unfortunately that's the way it operates. The reassuring aspect is that if you are in a solid financial position to clear your mortgage early, your credit is likely in a good shape overall. The slight and temporary dip on your score shouldn't have a significant impact on your financial standing. One way you can make an impact on this video is liking it below, so YouTube algorithm knows that you like this video and it may recommend it to other people. Now, a valuable tax deduction many homeowners enjoy is claiming mortgage interest payment on their tax returns, ultimately reducing their taxable income. These translate to lower tax payment, either decreasing the tax bill or increasing your refund, which means more money in your pocket. However, paying off your mortgage early means ending that interest payment and consequently the loss of the tax deduction. This could potentially lead to a higher tax liability. While it might be worthwhile in the long run, saving on years or even decades of interest payment, it's essential to grab a calculator and assess how it might impact your immediate financial future. Just like how this channel's future depends on your support. Support the channel by subscribing below. Before directing extra cash to pay off your home early, it's worth considering the impact on your liquidity. Cash is king after all. The additional money committed to your property becomes tied up in a non-liquid asset. If urgent funds are required, selling your property and accessing your money could prove time-consuming. Maintaining a sufficient pool of liquid assets is crucial. These are assets easily converted into cash without incurring penalties or fees, providing flexibility when immediate access to funds is required. Examples include your emergency savings, stocks, bonds, or tax-advantaged retirement fund. On the flip side, if your cash is primarily invested in your mortgage, you might find yourself needing to resort to a loan or credit card, incurring more debt and interest payment. Inflation gradually erodes the purchasing power of your every single dollar. When you have a mortgage, you're essentially borrowing money from the bank using today's dollar and repaying the loan on future dollar. Over time, the value of those dollars may diminish, but the repayment amount remains the same. Opting to borrow money now and settle the same amount later when the dollar value is lower can be a smart approach. This strategy has a more significant impact over a 30-year period compared to a 15-year span. By aligning yourself with the time and the effects of inflation, consider extending your mortgage payment for as long as it makes financial sense to you. But buying a home to live in it may not make good financial sense. Think of it this way. When you buy a house, you don't think of it as an income-producing asset. You buy it to live in it and make memories. Granted, after a few years, hopefully your home appreciates in value and you have equity in it. You can borrow money based on how much your house is worth or how much equity you have in your house. You can do this by something called home equity line of credit, which is HELOC, or by refinancing your mortgage to get some cash. But here's the thing. When you do this, you're basically borrowing against your house. Sure, it might give you some extra cash to spend it on other stuff, but it also means that you owe more money. And if you cannot pay it back, you could lose your house. Using HELOCs or cash out refinancing might make you feel rich right now, but it can mess up your finances in the long run. Some people kept borrowing against their houses thinking that it was a smart investment, but they ended up owing more than what their house is worth. So am I suggesting renting? Well, not necessarily. Yes, renting do have its charm. Imagine you don't have any costs associated with your home ownership when you're renting. Trust me, home ownership is not cheap. Between the routine fixes, upkeep, mortgage, insurance, which is by the way a whole new mortgage payment nowadays, it all adds up. So if renting is not an option for you, consider buying a duplex or fourplex or triplex where you can live on one and rent out the other units. In the best case scenario, you maybe collect enough rent to pay off your mortgages and all the costs associated with the property, so you end up living for free. And that also depends on finding the property like that and being able to afford it without losing a limb nowadays. Let me know in the comments below with a yes if you tried to purchase a home in the last couple of years and if you've succeeded, or no, or if you have not tried or you were not successful. All these risk factors brings us to two approaches on how to handle the debt. On the one side, there's a viewpoint that sees debt as inherently negative, urging individuals to clear their homes, paying off their mortgages early, and continue with their regular 9-to-5 jobs. On the other hand, there's the perspective that views debt more positively, and that's actually my perspective. So I suggest that you use your home to buy more homes until you have replaced your income. Still, the ultimate decision resides on your side, whether you want to clear out your mortgages ahead of schedule or not. Just look at all the factors, be it mortgage terms, source of your funds, retirement savings, or understanding your tax situation. These are all personal decisions that I cannot make for you. Buying a house and getting a mortgage is typically the largest and the most significant investment in a person's life. If paying off your mortgage early can save you a substantial amount of interest, it's certainly worth serious consideration. However, it's equally important not to neglect all other aspects of your financial well-being solely to eliminate your mortgage. But mortgage is just one part of your financial aspect. You waste a lot of money on a daily basis without even you realizing it. That is affecting your finances a lot worse than your mortgage payment. Don't know how? Check them out on this video. If you haven't already, like and subscribe. Thank you for hanging out with me. See you in this video.